Ladies and gentlemen, boys and girls, welcome to FinFluential Media. Welcome to the show. I am your host with the most, Chase. And what a day, what a week, what a year it has been. It truly has been crazy, and the days seem to get crazier, and we're going to talk about why. Everything that happened today, some of the crazy moves we saw in the stock, and some market leadership changes we're seeing occurring under the hood that's really going to affect your overall returns looking 1 year out, and it's also going to affect what happens as the stock market continues to be in this deep drawdown. We're going to talk about tariffs negotiations, China, what the market experts are expecting. And then we're going to look at some stocks I'm buying during this market volatility. But before we dive into everything, if you could please go ahead and subscribe, hit that like button as well as the notification bell so you don't miss any of my uploads, guys. Let's get into it now. Let's quickly have an overview of the market today. Very, very red except for two sectors, consumer staples and insurance. Very, very defensive sectors because what we saw today was some very, very ugly price action. We were very, very green at the start of the day in the S&P 500. At one point, we were up about 4%. And then we saw a pullback and a drawdown of nearly negative 3% at the lows. We're looking at a peak to trough swing of about 7%. So it really goes to show we are in incredible volatile times. And this is literally all because of Trump and tariffs. There were rumors going around. There was talking going around that we're potentially in the works with a trade deal as Liberation Day tariffs officially go into effect in about 3 to 4 hours. And things were looking very, very bullish. But as Trump poured cold water on that fact, we saw stocks and the markets make lower lows into the close. We broke the zero line and we actually finished down 1.4% for the day, seeing a peak drawdown of negative 3%. It was very, very ugly. Look at some of the big names in the market. Look at Tesla, right? Up 6% for the day, down 4%. That's a 10% swing peak to trough. Very similar situation at Apple, up 4% for the day, down 5%. Insane moves we're seeing. And that was the case for every single one of the magnificent 7 names. And after today's trade, we saw a stark leadership change. Microsoft is now the biggest stock in the world, although it's just ever so slightly, with Apple in second place and Nvidia in third place. Both these two stocks are down about 37% off their highs. Microsoft, not quite as much of a deep drawdown, but it really goes to show these names that the valuation was looking very stretched. Nvidia in the mid 30s, high 40s. Apple, in a mid 30s multiple, growing at 2% for the year. The market really turned sour on those, and they look to Microsoft, right? And that is why Microsoft the drawdown hasn't been as steep as Apple and Nvidia, because the multiple was a little less egregious, and Microsoft's revenue is less cyclical because it's less tied to the consumer. I guess Nvidia's as well to a degree, but the multiple was just crazy on Nvidia. And also there's a lot of uncertainty with tariffs on semiconductors. There aren't any at the moment, but that can change on a whim. And I think Microsoft right now is the most insulated from that. And that is why we're seeing, I guess you could say, a rotation into Microsoft. I would say it's less of a rotation out of Microsoft more than it is anything else. And you see it right here, Microsoft down just under 1% for the day. Apple 5%, Nvidia 1.37%. So that should tell you everything you need to know. And the reason why we're selling off is tariffs. And Donald Trump came out and said that he is collecting $2 billion a day from tariffs. That's actually a pretty big amount of money. That's close to $700 billion for the full year annualized. We don't know if this figure is true. And if countries do come to the table with concessions, this number is obviously going to decrease. And we are starting to see that. A number of countries are willing to negotiate. Look at stuff like Mexico, India, Israel, the UK, China, New Zealand, Asia, North America. Tons of countries are willing to negotiate. China has already retaliated, and we're still waiting on the European Union. We got some very minor attempts at retaliation, but the European Union taking its sweet time with regards to Trump's tariffs. Maybe they're buying time. I do know they have to vote on it, but either way, things can get worse once Europe retaliates. It's been a number of days since Liberation Day. but we'll see how things pan out. Now, Liberation Day tariffs officially kick off in 3 hours as of recording this video, and China is set for a 104% tariff. Now, the entire tariff won't go in today. The 50% response to China tariffs, so in like this would be Trump's retaliation to China's retaliation, is 50% additional tariffs. Now, this number right here, China's only goes into effect on the 10th, so tomorrow. So if China cancels that 50%, if China cancels their tariff of 34% on the US by tomorrow, this 50% tariff won't go through. However, if it does, we're looking at a 104% tariff for China in total, and that is a 34% Liberation Day tariff, and then we got 10% initial tariffs. There is also a potential 20% secondary Venezuelan tariff on top of this, but yeah, 104% tariff on Chinese goods coming into America with some exceptions that is really going to impact prices, and that is why economists are very sour on the growth prospects of the economy right now. This survey done by Bloomberg expects higher inflation and greater uncertainty. You got unchanged, about the same, more likely / revise higher, less likely revise lower. For example, GDP expectations, 93% of economists see this likely to be revised lower. Inflation expectations are more likely to go higher, right? Recession odds are more likely to go higher. The odds of a trade agreement is kind of mixed. You can see some are unchanged and about the same. Others believe we could actually come to a trade agreement. The market is still unsure as to what to expect. One thing the market is banking on is trade uncertainty. The most likely outcome is that we do get more trade uncertainty. And all in all, this paints a picture of higher inflation, greater uncertainty, and slower economic growth. And that's exactly what the betting markets are pricing in, a 66% chance of a recession this year. And if this is the case, this won't just impact the US, it'll impact global markets. Now, what am I doing about it? I am buying PayPal. I sold 9th of May puts. I sold 2 of them. I'm going to sell more into this week. I plan to have about 10 puts in total. I collected $758 in premiums, and pretty much it's a $57 put with a cost basis, if we get assigned, of about $54, a little bit under $54. And the reason for this is quite simple. If the cost of goods are going to increase, PayPal is really insulated to that inflation. For example, if you are now going to go ahead and buy a Chinese good that used to be $100, right, and is now $150, you still have to transact that amount on PayPal's network, on Braintree, on Branded, on Venmo with the PayPal debit card, right? And PayPal will collect a fee off that higher transaction dollar. Now, this can impact PayPal by lowering consumer spending. That could be the case, but I think the two will balance it out, and we probably will hit the consensus expectation targets as right here. And if we also just look at the valuation, PayPal's valuation is extremely attractive right now. And in times of uncertainty, you want to buy deep value, and if those companies are still growing with a strong moat around the uncertainty, i.e. the higher transaction margin dollar, that should bode very, very well. And to a degree, PayPal could be insulated from the overall downside in the market, particularly at these levels. For example, PayPal trades on an 11.92% free cash flow yield, nearly 12%, right? They're buying back a ton of shares, and an earnings yield of 7.3%. For example, look at the EV to free cash flow ratio of 8.55 times, an EV to EBITDA of 9 times, and a forward PE of 11 times. The valuation is very, very attractive. If we then go to forecasts, right, and look at what revenue growth figures are, consensus estimates are penciling in about 6 to 7% revenue growth through 2027, and you're looking at 28% double-digit mid-teens growth through 2027 for PayPal. Now, if we go ahead and plug this in, right, so we use the current year revenue, and we're assuming 6%, 5%, and 4% revenue growth through 2029, and we're using 20% in free cash flow margins. Now, if we actually just go to PayPal's free cash flow margins, I am building in a little bit of margin of safety via margin compression over the next couple of years. So you can see right now that here, PayPal's free cash flow margin is actually 21.8% for the full year. But if we actually go to the quarterly report, what has it been most recently? The free cash flow margin was 26% as their price to value strategy starts to take hold. And essentially, I'm looking at probably closer to a 20% free cash flow margin because of tariff compression, not this mid-20s multiple. Obviously, the bull case will be like this mid-20 area. So I'm looking at 20% free cash flow margins to grow to 23% in 2029. In an absolute bull case scenario, margins don't compress, revenue stays at consensus estimates, and we could definitely see a higher free cash flow rate in 2029, maybe closer to 10 or 10.5 billion. But we're using a 9.3 billion free cash flow number at the end of 2029. And we're going to apply a 12 times EV to free cash flow multiple. Now, even though the current EV to free cash flow multiple is 9, PayPal's average is about 15. So we're building a little bit of safety. I think 12 is an appropriate multiple. Then you get the enterprise value, subtract the net debt, you get the equity value and divide by shares outstanding. We're decreasing shares by about 4% every single year. PayPal decreased shares outstanding 6% last year. And at $57 per share, PayPal should see an 11% reduction in the float, stock-based compensation included. So that means the 2029 stock price should be $137. The current stock price is $57. So the projected compounded annual return is 19%. This is what I mean by deep value that's somewhat insulated to tariffs. I like PayPal. I'm going to go ahead and sell more puts. I'm maybe going to try and get 8 to 10 contracts in total, collect the premium, hopefully get assigned. If prices keep falling, we'll keep selling some puts, and hopefully I can get anywhere from 1,000 to 1,200 shares in PayPal at the end of this near the lows, and then we can just sit on it until 2029 and rake in the dollars. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.